it for financial statements. And then lastly, statement of cash flows, or the cash flow statement. So the name really hasn't changed too much. So again, just revisiting those statements again. Statement of financial position. If you look at a lot of financial statements from Europe, you'll notice a balance sheet that is completely upside down from what we're used to seeing. You start off with your long-term assets, then you got your current assets, then you got equity, and your long-term liabilities, short-term liabilities. Again, it seems to be a common way that they do things. It specifically says in IS1 that you can do it either way. So you can continue to do it the way we do it, current and then non-current, or you can do it that way. Either way is acceptable. Statement of comprehensive income. This is another item which, right now we have the order that we have here. Balance sheet is first, then income statement, cash flow. We've seen a lot of statements where you get the income statement up front. The thing about those companies are they're revenue companies. They have revenue. For them, that statement is much more important to them. So they want to have that up front. For a junior mining company, the balance sheet is where the majority of your expenses are. So that's the one you're going to want up front. So I don't see the order changing for most of our companies. I'll just say one more thing about the other statements. Oh, yeah, I'm touching on. Okay, sorry. Statement of shareholders' equity. I think that most of you will be familiar with that. All your share capital components on there, as well as your net income. Statement of cash flows. A lot of discussion about are we going to go to the direct method. Right now, there is nothing to say that you have to do that. I think most of us here do the indirect method, and right now that's completely acceptable. Who knows, down the road maybe they change their mind, but I think that, or I know right now that either method is acceptable. So moving on to the notes, it says in IS1 that you need to make an explicit, unreserved statement that you're in compliance with IFRS. So not compliance with IFRS under Canadian GAAP or according to Canadian rules or something like that, but you're under IFRS and you need to specifically say that. So the next point here, and I'm going to expand on this. I mentioned earlier your March 31, 2011 financial statements. Those are the first time you're going to have to adopt under IFRS. So I'll just sort of walk you through them. You're going to have on your balance sheet, your statement of financial position, you're going to have your March 31 numbers. And as you know, what's the next column? The next column is your December 31, 2010 numbers in this case. Now, you've filed those numbers, but you filed them under Canadian GAAP. They can't be under Canadian GAAP on these statements. They need to be under IFRS. Okay, so you're going to have that column under IFRS with a reconciliation in the notes going from Canadian to IFRS. And then in these statements, you actually need a third column. What you need is your January 1st, 2010, your transition date. You're going to have that balance sheet as well. Again, with a reconciliation in the notes explaining the differences. Okay. So, and I should preface by saying, if at the end of the day you really don't have that many changes, let's say you have, this whole process could be a lot simpler. Maybe you just sort of explain it. Maybe you don't need a whole schedule for it, but potentially you just sort of think about the statements. This is how it could look. Okay. Going to the income statement, on a first quarter, you're going to have two columns. Again, you've got a March 31, 2010 comparative number. Again, you would have filed your Q back in 2010 in Canadian, so that's got to be now reconciled to IFRS. Go to the cash flow, same thing, right? So you can see how these financial statements are getting bigger and bigger and bigger. Plus all the changes that you make, anything where you've decided where there is a difference between Canadian GAAP and IFRS, you have to explain that. So there's almost going to be this mini set of financial statements in your quarter with all your reconciliations and all your explanations and that sort of thing. Okay. The other one is, Rob's going to touch on IFRS 1, but there's a number of exemptions that you can take. And again, you have to explain all that in your notes as to which ones you've taken, why you have, even the ones you haven't taken, why didn't you take them? All these sorts of things. So those statements, certainly are the ones that you're going to be putting the most work into at this point. And certainly over the next 12 months, we will be working towards coming up with a set of financial statements that Davidson and Company feels is how they should look and how we want them to look, so that way we can help provide guidance when the time comes. So moving on to regulatory requirements in the MD&A. The Securities Commission's put out some staff notices addressing IFRS and what they would like to see in the MD&A over the next, not just when IFRS comes in, but starting today. So these are just a list for your reference that you guys can look at these staff notices at a later date. But I'm just going to hit some of the high points on the next slide. So starting December 31st, 2009, so your year end for this year, and again, if you're got another year end, you're going to be into 2010 on your next annual financials, right? What they've said is that you need to talk about, most of you, I think, at this point, in your note 2 there, your significant accounting policies, you've said IFRS is coming, and you may have a statement to say, we haven't, the impact is unknown at this point, or something like that, or maybe some of you even go a little further than that. So, but starting December 31st, 2009, your year end's coming up. That's not going to be good enough anymore, because really you're hitting the transition date, and you should have a rough idea what sort of an impact it is going to have. Now they're saying, and I've highlighted here, it only needs to be narrative at this point. So you just have to say that something like, IFRS is coming. These are the accounts that we expect will be impacted by IFRS, but you don't have to actually put any figures in that. And again, that would just be saying in your note 2 or whatever note it is that you have for your significant accounting policies. And when you move into your first quarter of 2010, again, you're still filing under Canadian GAAP at this point. You need to get a little more detailed, and what they're saying is you need to put some quantified information in there. Now, that's a quote exactly what the staff notice says, so it doesn't say anything more than that. So what does that mean? What it means is just you need to start dealing with the numbers, using language like is material, or even coming up with some numbers to show what the differences might be or what you expect them to be. So you have to address it in some regard. Exactly what that is going to look like, we're not exactly sure, but you do have to assess the impact, financial impact, whether or not it's going to be material and what those numbers might look like. Going through the rest of 2010, you're still filing under Canadian GAAP. It's going to be the same thing right to your year end. And what you want to add, and all the way through this process, if you have made any changes or if you have done anything differently, you certainly want to say that in there. Now, I'm talking about the MD&A, but of course, anything you put in the MD&A should be mirrored to a certain degree in the statement, so you want to have that consistent. So we're talking about the MD&A, but I'm really talking about the financials and the MD&A together. So March 31, 2011, again, this one I keep mentioning, that's going to be your first IFRS financial statements. The Securities Commission is actually looking at extending the filing deadline. So for most of you, if you're venture exchange companies, you've got 60 days to file currently. They're looking at extending it by another 30 days, giving you 90 days to file those. So in March you've got some extra time to work on those. They realize that these statements are going to be the most troublesome and the most, you have to put the most amount of work into them, so they're given a bit of time. That's not 100% finalized yet, but it's almost for certain that will happen. And again, moving down to the last date, we're just waiting to see. I'm sure that we expect them to put out some more staff notices in the coming months. So U.S. filers. So most of you here are Canadian companies, of course, but some of you do file in the U.S. as well. And the SEC has made some comments on 20F filers and what the requirements are. Currently, as you know, if you're a 20F filer, you need to, when you file your 20F, you need to put a reconciliation Canadian GAAP in your financial statements, usually at the back. That requirement has been lifted. If you're filing your financial statements under IFRS, you do not need to provide that reconciliation to US GAAP, from IFRS to US GAAP. So that helps things a bit. The other thing is on a 20F, on the income statements and cash flow, you've got your current year, but you're also going to have 2 years of comparatives. Again, if you think about the timeline, if you're doing your December 31st, 2011, which is the first annual year that you need to file your IFRS, and you're going to do your 20F for that year, and if you have to go back 3 years, you're going to have to go back to the beginning of this year to try and get all your comparative numbers, and they would need to be in IFRS. So what they've said is you don't need to go back that far. 1 year of comparatives is sufficient, and that'll take you to your transition date of January 1st, 2010, which is all the work that you've done. So that works out well. So I just thought I'd again, most of your Canadian companies, I thought we'd just touch on a couple things about the U.S. What is going on down there? So they have begun the process on converting to IFRS. They'll likely decide next year or the year after when they're going to make the convergence. They haven't actually said, okay, this is the date we're going to go. They haven't put that in place. Part of the reason is it was a big focus for them, but of course, you guys know there's been a lot of scandals in the U.S., and so they're kind of focusing their attention on that. And this is not taking a backseat, but it's certainly not at the top of the heap as it maybe was. At this point, they have come out and said 2014, 15, 16, somewhere around there, will likely converge with IFRS, but there's nothing concrete at this point, so we're still sort of waiting to see what happens with that. So I think now I'll turn it over to Rob, and he'll take you through the rest of the slides.
I'm not Rob, but I did forget to mention a couple of things that are in the beginning. I was getting so excited about this IFRS stuff, as I know you are, so I forgot to mention a few things. But there's a lovely lady at the back, Jessica, and if you've got any questions as we go through this, just put your arm up, and then she'll hand you over a question card, and you can write down the question, and then we'll go through a period in the end where we'll answer some of those. Also, if you just have a general question, you can write on the card, and we can email it to you, however you like it. But as we go through it, feel free. So we'll leave about a 15-20 minute period. And then in your handout, you probably have already figured out that these slides are in there. And then that's the back part. And then the first part of your handout is also just sort of, we developed a very short practical guide on the major sections between Canada and IFRS that will give you, okay, here's property, plant, equipment, here are the big differences. So that's just the top of your handout. So now here's Rob. Thanks.
Thank you, Erez. Can everybody hear me at the back? Okay, just wanted to make sure. So what we've got up here right now is the standards. I'm not going to go through them all. It's just a reference guide so you can know what they all are. There's 37 of them. I'm not going to talk about them, other than the fact that Erez had mentioned earlier, IFRS is at the top. That's after 2001. IASs are after that. The reason that there's gaps is because IASs have been dropped since 2001 and replaced by IFRSs in most of the cases. So if you wonder why you're going from 2 to 7, it's because those IASs don't exist anymore. And we'll just start flipping through these until we get to SIC, or IFRIC actually, and these are the IFRICs. These are the EICs. So there's 37 standards before that, and this is where you're starting to get your interpretations. And as we go through these, there's 18 of them, and those are actually in numerical order, like the IFRSs, because they're after 2001. And the 6, again, pre-2001, there's a gap between them. That's why. This first one I got into that confused the hell out of me. It's like, are they missing a bunch of them? What was going on? And that's the explanation. Now what do you guys actually care about? IFRS 1, first-time adopters. What's the purpose of this? The purpose of IFRS 1 is to give specific transition rules. because IFRS is a standard that people are taking on, the ISAB gave a specific standard for those people who are adopting IFRS. The only time you're going to deal with IFRS 1 is the first time you're adopting IFRS. So it's a one-time only that you're going to use this, and it gives you your transition disclosures. And the general rule under IFRS is that you've always reported under IFRS. That's the idea. You're going fully retrospective. You're going back, and you're going to report your accounting records as if you'd always done it in IFRS. The exceptions to this are the elected exemptions. There's 16 of those. There used to be 14 until July 2009, and they added 2 more. The one that we care about really in our industry is anybody who has an oil and gas company. There's a full cost exemption available now. So if you're reporting under full cost oil and gas deferral, you're able to elect to keep those full cost pools because there was worries about that was being allowed. I'll go into that a little bit later. And then there's mandatory exceptions. There are 5 of those, and you're required to take those. So let's go into the next slide, the mandatory exceptions. Derecognition of financial assets and liabilities, hedge accounting, estimates, assets classified or held for sale and discontinued operations, non-controlling interests. The first of these is the derecognition of financial assets and liabilities. The idea here is I've derecognized assets in the past. I haven't put them on my balance sheet. I've got an exemption that's mandatory. It says I don't need to re-recognize these. The exception to that rule is if you've got financial instruments, which for the most part we're not going to see in the type of industry we're in. So we're not going to see a lot of those financial instruments hitting us. So for the most part, that's going to let you avoid from re-recognizing assets. Estimates, similarly. If you've based an estimate in the past, you've said, this is my estimate, fair value at that point in time. You don't have to go back at your transition date, January 1st, 2010, and redo that estimate. You get out of it. So really the point of that is it takes you a lot of time, a lot of effort, and costs you a lot of money for something that wouldn't really do any good for the company in terms of reporting. So they're giving you a way of doing the cost-benefit analysis as to what is really going to affect the financial statement user. And the rest of these really aren't going to affect most of us. Hedge accounting, I don't think there's a lot of venture companies that are into hedge accounting, but you do get an exemption on it. And now we'll go on to the exemptions, which are something that people actually need to consider. You need to document your choices, what's important to you, what's not. And as I said, there are 16 of these. I didn't want to put them all up because it's a lot of exemptions that aren't necessarily applicable to the companies that we're dealing with. So we've got business combinations, fair value or revaluation of deemed costs, cumulative transaction adjustment, compound financial instruments, oil and gas full cost accounting, share-based payments, fair value measurements of financial assets and liabilities, and borrowing costs. Idea with business combinations is you've got specific IFRS rules on business combinations, which can differ from Canadian GAAP. And even the Canadian GAAP that we had, 7 years ago, 8 years ago, is different than the business combination GAAP that we currently have. So the idea here is if you had a business combination that you put together in 1980, you don't have to go back to that and change to report it under IFRS. If you choose to, you can. But for the most part, people aren't going to want to go back, and they're going to elect to opt out of that. Now, when you're making that decision, you need to document it. You need to say the reason that we don't think that we're going to elect out of it is that we think it's best for financial statement presentation. We don't see any big changes. Document that you've made that choice is the key part of that. And Dean auditors, we're going to have you over and over again on that, because it is important to document it. But the regulatory authorities are going to worry about that too. Are you making those choices? Are you actively considering that? Fair value or revaluation of deemed costs. Sorry, I was getting confused with fair value measurements of financial assets and liabilities. What you have here is the ability under IFRS to fair value your assets. IAS 16 is property, plant, and equipment. You have the ability to fair value your assets, which is unusual, which is not the same as Canadian GAAP. Canadian GAAP using cost. You have the ability under IFRS to say, no, I've got an office building. I think it's worth a lot more than I've got on the books right now. I want to fair value that. So you can go on an asset by asset basis and say, I want to fair value this. I want to use cost on that. You don't have to elect it all for the class of assets. But really the applicability in my mind to that is when you have investment property. Because I mean, you don't want to fair value your cars. It's a lot of work for nothing. So for the most part, you're going to keep on using the numbers that you had before, elect to keep it at cost. Oil and gas full cost accounting was another one that I talked about before. So if you got your full cost pools in your oil and gas company, you can just keep those full cost pools. You don't have to split them up until you start moving into a production phase. Then you start getting into your impairment tests. But you're allowed to carry those forward under IFRS. Share-based payments. Under IFRS, the way that you calculate stock-based compensation is in the graded method. Well, a lot of our clients are using the straight line method. So you say, and I'll get into this a bit further, so you don't have to take too detailed of notes. But prior to transition date, if you use the straight line method, that's acceptable. After transition date, you need to use the graded method, so you don't need to go back and re-report your share-based payments that you calculated previously using the selection. And that's definitely something that most of our clients are going to want to do, because you don't want to go back and go do 20 years of SBC, or 10 years of SBC. And so we'll go to the next slide. Documenting your choices on the auditor's an auditor slide. But this is important. It's important to consider it. And on transition and initial adoption of standards, you need to consider why you're doing it. Take a little bit of time. This is set up the process right. If you have options, make sure that you're saying, why is this best for my company? For the most part, it's going to be cut and dry for you guys. There's not a lot of changes. I mean, you don't have to worry about it significantly. So when you're doing this, when you're presenting alternatives under IFRS, the company needs to document, clearly identify the options that are available.